The bull runs that rewrote fortunes. It began with a spark so subtle that almost no one noticed. A quiet rise in price, a flicker of interest, a hint that the market's long slumber might be ending. But soon the spark grew into a blaze, and that blaze became a global phenomenon. Screens lit up with green candles stretching toward impossible heights. Wealth appeared to form out of thin air, and the world watched as cryptocurrency entered one of its most explosive cycles in history. Today, these bull runs are legendary. Moments when doubt transformed into euphoria and ordinary people became accidental millionaires. But to understand why they mattered and why they reshaped the psychology of an entire generation of investors, we must revisit the periods when optimism went from cautious to unstoppable. Because long before the world celebrated these surges, their foundations were quietly built through years of innovation, struggle, and belief. The first signs emerged after seasons of stagnation. Developers kept building to the bear markets, adding features, strengthening infrastructure, solving problems most outside the ecosystem never saw. Miners continued securing the network, even when their rewards felt painfully small. Communities shared knowledge, improved tools, and kept the flame alive. Confidence grew slowly, block by block. Then adoption increased. A few major companies integrated digital payments. A handful of governments hinted at support. Influential voices began discussing the possibility that cryptocurrency wasn't just experimental, it was inevitable. Each announcement added fuel. Each new believer added momentum. The market began to rise in a way that felt different from past recoveries. The reveal came when institutional investors entered the scene. Hedge funds, once dismissive, began accumulating. Payment companies added crypto options. Analysts who had mocked digital assets now issued reports filled with cautious admiration. With every new participant, the market gained credibility. And with every surge in credibility, the price rose faster. But beneath the excitement lay a deeper truth. Bull runs were never just financial events. They were emotional turning points, moments when the world questioned long-held assumptions about value, technology, and the future of money. And as the rise accelerated, as fortunes multiplied, one question hovered in the air like static before a storm. How long could this momentum last before the cycle turned again? As the rise gained momentum, the market transformed into a spectacle that captured global attention. Social feeds filled with charts climbing at impossible angles. News anchors who once dismissed cryptocurrency now spoke about it with urgency. New investors flooded exchanges, each convinced they were witnessing the beginning of a new financial era. Confidence spread like wildfire, and with it came the unmistakable feeling that nothing could slow the ascent. But the unstoppable climb carried its own tension. Prices rose so quickly that even seasoned investors struggled to keep perspective. Some felt exhilarated, watching their portfolios multiply in ways they had never imagined. Others felt uneasy, sensing that rapid growth often hides fragility. Every dip was bought instantly. Every rally fed the belief that the old rules of markets no longer applied. Institutions played a pivotal role in amplifying the frenzy. For the first time, major corporations announced crypto holdings. Payment platforms enabled digital asset purchases for millions of users. Banks explored blockchain integrations after years of rejecting the technology. Each announcement sent waves through the market, reinforcing the narrative that cryptocurrency had crossed a threshold from outsider to contender. Yet cracks formed beneath the euphoria. Fees rose sharply as networks struggled to handle unprecedented traffic. Delays frustrated users. Rumors spread of exchanges pausing withdrawals during extreme volatility. Critics used these issues as evidence that the surge was unsustainable. Supporters insisted these were temporary symptoms of overwhelming demand. The debate intensified, mirroring the pressure building inside the market itself. At the same time, cultural forces added fuel. Online communities celebrated every milestone with contagious enthusiasm. Memes, jokes, and bold predictions drew millions into the conversation. Influencers emerged overnight, offering advice that blended optimism with speculation. For many newcomers, the line between entertainment and financial decision-making blurred, creating an environment driven as much by emotion as analysis. And then there were the quiet observers, developers, researchers, longtime believers who watched the excitement with mixed feelings. They recognized the importance of mainstream adoption, yet worried that speculation was overshadowing innovation. The market's rapid ascent risked distorting the public's understanding of what the technology could truly achieve. Still, the rise continued. Every correction looked like a temporary pause before another explosive rally. Investors who once entered cautiously now doubled down. The idea that cryptocurrency could rewrite financial norms no longer seemed unrealistic. It felt inevitable. But beneath the triumph, an old, familiar tension grew. Bull runs have a gravity of their own, lifting hopes to extraordinary heights. And as history has shown, the higher the market climbs, the more powerful the pull becomes when sentiment shifts. The cycle was gaining heat, and the world, swept up in optimism, was drifting closer to a moment where exhilaration would collide with reality. The higher the market soared, the more intense the emotional turbulence became. What had begun as cautious optimism twisted into collective euphoria, a belief that the climb would never end. Screens glowed late into the night as investors around the world watched numbers rise with dizzying speed. Every new milestone felt like confirmation that a new age of wealth had arrived. But beneath the celebration, an undercurrent of fear pulsed quietly. The conflict emerged when expectations eclipsed reality. New investors poured in with dreams of instant prosperity, pushing prices even further into uncharted territory. They shared predictions with absolute confidence, convinced that corrections were relics of an older financial world. But veterans recognized a familiar pattern: parabolic growth that defied fundamentals, liquidity stretched thin, and sentiment tilting toward mania. The air grew electric with excitement, but also heavy with the weight of inevitability. As the frenzy intensified, pressure on the network surged. Transactions slowed to a crawl. Fees spiked so high that small users were priced out entirely. Critics seized a moment, arguing that a system meant to democratize finance was now too expensive for the very people it claimed to empower. Supporters countered that temporary congestion was a sign of unprecedented adoption, but no explanation could quiet the frustration building among newcomers who felt the system was failing them at the moment they needed it most. Institutional behavior added to the confusion. Some major players took profits quietly, releasing carefully worded statements that hinted at caution without panicking the market. Others announced bold new positions, fueling rallies that reignited optimism. To outside observers, these moves looked strategic. To ordinary traders, they felt cryptic, signals that deepened uncertainty even as prices reached staggering heights. Inside the community, the emotional divide widened. Builders urged patience, reminding everyone that market cycles were part of the journey. Traders warned of overheated sentiment. Newcomers dismissed these warnings as fear-mongering. Every disagreement reflected the deeper tension between the belief in long-term transformation and the temptation of short-term gain. Media coverage poured gasoline on the fire. Headlines glorified overnight millionaires. Talk shows debated whether cryptocurrency was the greatest invention since the internet or the largest bubble in modern history. Governments issued cautious statements, some hinting at regulation, others expressing optimism. Markets reacted instantly to every word, rising and falling with the unpredictability of a storm-tossed sea. As these forces collided, a subtle shift began to take shape. Small red candles on charts that had been green for months. At first, investors brushed them off as noise, but the dips grew sharper, the rebounds weaker. Whispers of doubt emerged in online communities. Those who had entered at the peak felt panic nibbling at the edges of their confidence. Those who had profited wondered whether it was time to step back. The emotional pressure reached its peak when the market paused, just long enough for everyone to sense that something had changed. The upward momentum that once felt unstoppable began to slow. And in that fragile moment, the entire ecosystem held its breath, sensing the cycle nearing its turning point. The buildup was complete. The bull run had reached the edge of its own gravity, and the next movement would determine whether fortunes held firm or unraveled in the blink of an eye. The turning point came with a sudden shift, small enough to ignore, sharp enough to unsettle. A dip that should have been routine lingered longer than expected. Buyers hesitated. Sellers grew bold. And in that hesitation, the momentum that had carried the bull run to dizzying heights began to crack. The climax unfolded in cascading waves. A single correction triggered a chain reaction of panic selling. Exchanges overloaded as users rushed to salvage gains. Charts that once pointed skyward turned violently downward. The confidence that had fueled months of relentless optimism evaporated in hours, replaced by disbelief and a silence that felt heavier than the crash itself. When the dust settled, the aftermath revealed something far more complex than a market collapse. Some investors had lost fortunes. Others, having anticipated the reversal, emerged with newfound clarity. But beyond the numbers, a deeper transformation had occurred. Bull runs were no longer just financial events. They had become emotional rites of passage, shaping how millions understood risk, reward, and the unpredictable rhythm of innovation. Reflection came slowly. For many, the crash was a painful reminder that markets move in cycles, not straight lines. For others, it was a lesson in humility and resilience. Yet despite the losses and the shock, the technology remained. Networks continued operating. Builders kept building. The vision behind digital currencies endured, untethered from the chaos of price movements. In time, clarity returned. People began to see that bull runs weren't accidents. They were accelerators. They brought attention, funding, curiosity, and millions of new voices into the space. They revealed strengths and exposed weaknesses. They pushed the ecosystem forward, even when the aftermath felt like ruin. What mattered most wasn't how high the market rose, but how the community chose to evolve after fall. With every cycle, the foundations grew stronger, the lessons grew sharper, the conviction grew deeper, and the future grew more defined. So what do you think? Are we repeating the same mistake again?